Today I'm at this little section where Belvedere Island meets Tiburon, and they have this beautiful backdrop over here with the water and the marina. Unfortunately, we can't walk around there because it's a private marina, so I'm going to take you guys to the neighborhood instead, and my lovely wife Lizzie will be joining us for the walk.
Hi guys.
Now, the other day I covered how so many different insurance companies are going to be dropping people, or basically not dropping them, they're dropping coverage of basically any type of natural disaster because they're saying it's too expensive, they can't absorb these losses anymore, and so they're just going to start dropping the natural disaster coverage part of all these insurance policies, and basically in places where people need it the most. So if you're at risk of a fire, you're not covered for fire anymore. If you're at risk of a hurricane, no more hurricane coverage, and so on and so forth. Those are really the two big ones, but there are other things that are happening with this as well. But anyhow, let's talk about what are going to be some of the implications of this, because insurance is such a big deal, guys. Without insurance, the real estate market's going to come to a complete standstill, because if you cannot obtain insurance on a property, say goodbye to getting a mortgage. That's basically where things are at. So there needs to be either a serious revamping of the insurance and the mortgage industry for things to move forward under these conditions, or things are going to fall apart pretty rapidly. Now, one of the big recent weather examples of this that just happened is Hurricane Idalia smashed into Florida, and luckily it hit basically the most unpopulated portion of the state, and it was a strong Category 3 storm. And if it would have hit just a little bit further south or went a little bit further to the west and hit the panhandle, it would have been a much different story in terms of the amount of devastation, the amount of people that have lost their homes, and all of this. Some of the things that can happen from these storms hitting more often now, you're going to have premiums that are going to continue to go up, okay? You're going to have reduced availability of coverage. Those two things in combination are the death blow for real estate. This can also prevent future developments from taking place in different areas. It also can affect the future economy in certain areas, because without development, without growth, the area eventually dies. Ultimately, so do the cities, because then the tax base starts to dwindle as well, because you have less residents, you have more homes that have gotten destroyed and they're not being rebuilt, developers aren't coming into the area. So the city that was collecting property taxes from 100,000 residents now is only collecting it from 80,000. And then if they get smashed with another hurricane or another wildfire, that gets diminished even further. So you can see how that can be problematic. And so the ratings agency Fitch, that recently just gave the US a credit downgrade, they're also taking a look at what could be happening from this insurance debacle. And they're saying that Florida has the highest homeowners insurance premiums in the country, which I can attest to as a Florida resident, as I'm sure many of you can as well. And they're looking at this fact that you have Farmers and Allstate and these big insurance companies, pulling out of the state and refusing to write policies any further as a huge red flag. They also are looking at the fact that Citizens Insurance has grown exponentially over the past couple of years, and they're slowly kind of offloading some of these policies. Like, I think over the next couple of months, they're going to offload maybe 100,000 people off of Citizens onto other private insurance companies like Slide. We covered this a few months ago, but it's definitely nowhere near the 1.4 million policies that they're carrying at the moment. And here's what Fitch had to say about this. They said recovery following natural disasters may be delayed or incomplete if there are greater numbers of those who are underinsured or uninsured due to affordability or non-renewal issues. And this is basically the number one thing that's happening across all of Florida and California, in the riskiest areas anyways. It's not like it's happening everywhere, blanketed across both of these states, but in the areas that tend to have the most wildfires and the coastal parts of Florida that get the most hurricanes traditionally are getting hit with these non-renewals and big increases. Now, so far, we really haven't seen a situation happen where, there's been such devastation and they don't rebuild, and basically the local town and city loses its tax base, and the whole entire area, basically starts to deteriorate from that point of view. But just because it really hasn't happened yet doesn't mean that it won't happen in the future as we keep getting slammed with these storms. Now, Hurricane Idalia was a Category 3 storm with 125 mile per hour winds, guys. So it was a serious hurricane. It made landfall in the Big Bend region, which is like a very unpopulated region of Florida, okay? Only 22,000 people live there. So imagine if a storm like that were to go a little bit further south and hit Tampa, or go a little bit further west and hit the Destin area, that big tourist zone over there. It would have been a much different picture in terms of the amount of damages. We're talking billions of dollars in damages and repair costs, and this is just going to make insurance completely explode. And it's not just in Florida either, guys. Like, yeah, we're getting hit with it the most, but you ever see when you have your car insurance and you get that increase, even though you haven't been in an accident? That's because they're trying to cover their losses from other situations. People that have gotten in accidents in different parts of the country, not even necessarily in your area, doesn't matter. And by the way, we're kind of getting squeezed apart here because this sidewalk is super narrow.
I get to get closer to you.
Yeah. Now, the crazy thing about this is we are not going to know the impacts of Hurricane Idalia yet when it comes to insurance for at least another month, because they're saying about 9 out of 10 people will file a claim in the first 30 days, and that information gets reported to the Florida Office of Insurance Regulation. And so far, they've received only about 800 claims, which isn't very much considering 22,000 people live in the area. So we're likely to see way more claims roll in over the next several weeks. Citizens Insurance is saying they have claims adjusters on standby right now, and they've already flown over the damaged area to kind of assess what happened over there. And after Hurricane Ian, Citizens Insurance had 68,000 claims, and they're expecting less than 10,000 for this one. So it'll be interesting to see, if they're right. Probably because there's not that many people that live in the area. So basically, Florida's insurance market kind of dodged a bullet with this, right? But what about the next one? It's just going to be a matter of time before we get slammed with another one. But these insurance policies actually have a nice out with this, because obviously if most of the damage from the storm came from flooding, like in Tampa, they got a big storm surge over there, but really no wind damage or anything like that, you're not covered, guys. Unless you have flood insurance, you're out of luck. That your homeowner's insurance does not cover flood. I don't know how many people know that. I'm sure many of experienced real estate owners know this, and you need to have a separate policy for flood. But in case you didn't know, you live in a flood-prone area. Even if you don't, if it's not that expensive, you might want to have it. And obviously, in places like this where we're walking, like there's a canal right on the other side of all these houses here, I'd be willing to bet that flood insurance costs a lot more here than it does on top of the mountain somewhere. So the closer you are to the water, the higher the likelihood of flooding, the more you're going to pay for the flood insurance. And the other thing that's going to be interesting to see after we've already gotten hit with a hurricane this year in Florida is if we're going to see any other companies go bankrupt or insolvent, or decide to pull out of the state altogether and not write any more policies, because really our insurance situation there is working off of life support right now. And if more companies decide to leave or they go insolvent, it's going to spell disaster for the state. And you can guarantee it's just going to lead to way higher premiums than what we're already dealing with right now. Now, there is some good news out of all of this, and that is that starting on September 1st, they put in a temporary measure where insurance companies will be prevented from dropping customers in the areas that are affected by Idalia. So they won't be able to cancel anybody's policy until October 31st in the following counties, and I'll put them up on the screen here in case you live in one of these areas. You need to make sure, guys, if you need to file a claim at all from this, to do it before Halloween, because there is a possibility that if you don't, then you're not going to have any chance to make a claim, and who knows, maybe your insurance company will end up dropping you, even if you had no claims and no damage, just because you live in an area that was potentially affected by this natural disaster, because that's the direction they're moving in all of this. I covered this a couple days ago. If you didn't see that video, go check it out. But that's what insurance companies are doing. They're starting to change policies. So this is not going to be so much of an effect this year, but starting in 2024, a lot of them are going to stop covering natural disasters. That's why I'm telling you, if you had any damage at all, you probably should make a claim, because you know, this could be your last chance to essentially make a claim for something like this. And it's also not a guarantee that every insurance company is going to stop covering natural disasters, but a lot of the big ones I named in that video will. I think it was Allstate, Berkshire, Hathaway. I can't remember some of the other ones, but there was a good amount of them that are well-known insurance companies. Oh yeah, Nationwide, definitely not on your side when it comes to this. Just be ready for that to happen. And supposedly the Insurance Regulation Office is saying that they're going to be on top of these insurance companies to make sure all these claims get filed and processed and facilitated in basically a quick fashion. So hopefully that'll be the case. Hopefully the government is going to do something about this. They're going to be looking at doing things like streamlining claim payment processes, as well as using technology to provide prompt and efficient claims service to policyholders, things like that. So, you know, all this typical government talk that makes it sound like they're doing a whole bunch of things for all the money we're paying them in taxes. Here we have a house listed for $11.5 million on the water, and they bought it 2 years ago in 2021 for $10 million, so it's sort of a flip. They held it for 2 years, trying to make a profit by selling it 2 years later. But here's the crazy thing. When you look at this instant valuation tool that I have with the MLS, it says it's only worth maybe $5.7 million, and that the value of this home went down by 12.3% last year. Can you imagine, guys? Real estate doesn't go up everywhere, let me tell you. And also, look at this crazy property tax bill. When they bought it, previous owner was paying almost $12 grand a year. Now they're paying $118,000 per year in property taxes. Now moving on to the broader housing market, we are starting to see mortgage applications continue to drop. Now this isn't exactly a new thing, but it's dropping so much right now that it's literally at the lowest levels that we've seen in 28 years, guys. Since April of 1995 is the last time mortgage applications have been this low. And just from 1 week to the next, from last week to this week, it fell an additional 2.1%. That's down 28% from just 1 year ago. And this applies to both purchase and refinance applications. And the crazy thing is, we're probably gonna see the 30-year mortgage rates continue to go up, because the 10-year treasury has also been moving up recently. Because what does that mean, guys? It means that these guys are scared that we're heading into a recession. These bond investors are betting on the fact that we are going to be going into a recession very soon, and that's why you're seeing the 10-year treasury move up. And with that moves up the mortgage rates. And the higher these mortgage rates go, the less you're going to be seeing people buy. And I think one thing that people need to understand right now is all of these closed sales that we're seeing, there's a good chance that a large chunk of those people who are buying are either buying in cash or are putting a significant enough down payment, maybe even half. You don't really know, right, how much they're putting down to soften the blow of how much they're going to be paying in interest. And someone like that will actually be able to refinance when rates do come down, because chances are they're probably not going to lose half the equity in their home. So even if they lost 20%, they would still have 30% equity in that case. So people who just have a lot of money to burn right now, or baby boomers that are giving their children money to buy houses, that's what I think is basically driving this whole market right now. Any of the closed sales you see happening at this very moment is likely people in these situations. And when you see these mortgage application numbers almost at a 30-year low, you know that something's fundamentally broken in the market. And that's why I just get so tired of people saying that, oh, this is all going to be fine and it's only going to be up from here. Like, from who, guys? Who's going to continue to buy? We know that sales are at record lows right now. We know mortgage applications are at record lows. So tell me who's going to buy. Because if you think BlackRock and all the mom and pop investors have enough cash to just come in and swoop up and buy every single thing that's going to come on the market, that's a joke. It's not going to happen. And that's not how they work anyways. Investors are strategic in what they buy because properties need to cash flow. They need to be in growing areas where the economy is going well. People are moving into the area, not moving out, and there's jobs being created. They don't invest in places that are falling apart. You think investors are going to be going and buying in San Francisco right now, where 12.5% of people selling right now are losing money? I don't think so. So it's no wonder that every time, almost every week, I share these emails with you guys from different mortgage brokers talking about how everything is so great and that you should get in and buy right now before you're totally priced out of the market. And they come up with all of these creative financing strategies to get people to pull the trigger on the home. You know, it doesn't matter. They don't care if you have to not pay your student loans to get the mortgage. You know, they don't care if you only have 1% to put down. They have a program for you. They don't care if your credit score is only 580. None of that stuff matters. All that matters is that you buy today so that way they can get paid, okay? And I'm not saying that everybody who works in mortgages and real estate are evil and, you know, they're just out to get you, because it's definitely not true. I've worked with plenty of great people in the past and, you know, I can vouch for them, guys. But the reality is these are commission-based businesses, and if you don't buy, they don't eat. So that's pretty much where things are at with this. And when you have mortgage applications that low and closed sales coming in extremely low as well, people are not doing good with this. And the thing is, you have to understand this has a ripple effect throughout the economy, because you have all these mortgage people and real estate people that base their cost of living off of what they expect to earn each year. So since there's really no way that they know how much they're going to earn, they kind of just go year by year, and if it's going well, if it's not going well. And when these people don't make a lot of money, guess what? They're not out spending a lot of money, which is bad news for the economy. And in case you forgot, 80% of our GDP right now comes from consumer spending. If people who work in the real estate business and mortgage business slow down on their spending, that's less people going out to restaurants, going to movies, bars, taking vacations, right? Starting on October 1st, which is just a couple weeks from now, we have the resumption of the student loan payments. Once people start paying that, average $400 a month, that's $400 that's no longer going towards those things either. So what do you think that's going to do to the economy? In fact, one of my favorite people on YouTube who's extremely smart, George Gammon, he recently made a video about this, and he said there was like a 93% chance that we're going to hit official recession by October 1st because of this. He's so certain that that's what's going to happen. And this guy's really smart. So if he thinks that's what's going to happen, I think he's probably right. But it's easy to be fooled by all of the headlines and people who kind of speak against this and say that that's not going to happen, because, you know, literally I saw another story today talking about how U.S. household wealth rises to a record $154 trillion in the second quarter of 2023, okay? So just in this quarter alone, it rose 5.5 trillion. And this is the third straight quarter that household wealth apparently has grown. This is attributed to 2.6 trillion gain in the value of stocks and also a 2.5 trillion gain in the value of real estate. And this story that I found they put this tweet in from somebody called Sam Rowe. I don't know who he is, but they put a graph in here showing the trillions of dollars in net worth essentially that people have. And the funny thing is, when you look at this chart, it only goes to like Q4 of 2009 all the way up until today. And one thing you'll notice, if you look all the way to the left side of this chart, back then wealth was on the downside, and it doesn't go back to 2007 or so when things really started falling apart, when we hit the great financial crisis. So I'm willing to bet if you could move this chart a little bit more to the left, you would see how household wealth was probably at an all-time high back then until it wasn't, and it started falling down. And I think that's exactly where we're going to be headed after this recession kicks in. They literally say that the health of the consumer has been a big factor in the surprising strength of the U.S. economy this year. Talk of a recession has vanished, and the economy seems to be strengthening as the year progresses. Wow, doesn't that sound so amazing, right? So optimistic. But you have people like George that study the economy every single day and predicting there's a 93% chance we're hitting a recession by October 1st when the payments come due, because that means GDP is going to drop to the floor, guys, because nobody's going to be having the extra money to go out and spend on anything after this. Here's the funniest part out of this entire story. You have them saying at the end of it, the 10-year treasury now is up to 4.26%, as if that's a good thing. That really means that investors are scared right now and are betting on the fact that there's going to be a recession. It also means that mortgage rates are going to continue to go higher. And somehow this is supposed to be good news. So you're literally seeing a lot of people right now that are ingesting bad news and converting it in their mind to good news, because they still see their portfolio is doing well, and they still see that the value of their home is still doing well, and that means that all is right in the world. But it's very common for this to be the circumstances until it isn't. This can change very rapidly, and that's where I think we're headed. Now, I could be wrong. That's just my prediction. What do I know? I'm just some guy on YouTube, right? But what I do is I study what other people talk about. I look at how smart other people are, like George and some of my other YouTube colleagues that, study this stuff every day, guys. I think if you have people like that backing up these claims that we're going to be entering this recession with real data within the next few weeks, I think we should be paying attention. But I think it's very dangerous also to predict timing on things like this, because nobody really knows, right? Nobody knows what the government's going to do or the Fed's going to do when it comes to bailing things out, because one thing that we know for sure is we've essentially not been allowed to have a recession since the whole pandemic happened, right? Like, we were supposed to have a recession back then, but they thought it was a good idea to print $6 trillion instead and take that route. But we see where that ended us up. It ended us up right here in Euphoriaville, where everything is fake. The value of everything is not grounded in reality. And so when the recession actually does hit, and I believe that it will, if you don't already believe that we're in one, because technically we already had our 2 quarters of down GDP last year, and they didn't call it a recession. So whether they're going to call it a recession this time, who knows? I don't really care. To me, it doesn't matter what they call it, because when it happens again, whether the government claims it as official or not, doesn't really matter to me. I just look at the facts. But I think this time what they're going to see, they're not just going to see a down couple of quarters with GDP, but they're also going to see unemployment go up. And that's going to make the big difference between this time and what happened last year, because that's basically the only leg they had to stand on last year of why it wasn't a recession, because we didn't have unemployment going up so much. So no big deal, no recession here. And ever since, things have recovered, right? But that's just because 80% of GDP is based on consumer spending. Now, the last thing I wanted to mention here in this video is people are being forced into early retirement pretty much against their will right now. And usually it's due to things like the company's downsizing, so they try to offer you some sort of like severance package where they say, hey, I know you still have like 5 more years left or whatever, but we'll give you this lump sum of cash and some benefits to take off early because things aren't going so well. And this is happening to more and more people right now. And for some people, that might be a blessing, especially if they're already well prepared for retirement. But for some people, it might be a big kink in their plans, because if they weren't doing a good job at saving for retirement along the way, then this can be very problematic. And according to a recent study from Edward Jones, they claim that 40% of their clients were forced into retirement recently. Sometimes it's not even about the company either. Sometimes it's about health issues or things like that that make it so that they can't actually perform the job anymore. But here's the real problem, and why I wanted to bring this up real quick, is because literally 1 in 5 workers believe that they need about $2 million to retire, and people don't have anywhere near that for the most part. If you actually need $2 million when you hit retirement and you don't have it, what are you going to do, guys? Well, unfortunately, the only thing to actually do is to continue working, which sounds so counterintuitive, right? Like when I was a kid, I remember when you hear about somebody who's retired, it's like, that means they don't work. And for me, even today, it seems such a foreign concept to think that somebody is retired, but they have a job, right? Because, well, you're not really retired then, you're still working. And the reason why most people aren't prepared for retirement is because actually a lot of people don't think about it before it's too late. You have a lot of people that don't worry about if they have enough money for retirement until they're getting closer to retirement age, which by then, obviously, it's too late. So the more people that get forced into early retirement that actually shouldn't be retired, this could be problematic. And going back to what I was just saying, talking about reduced spending being the cause of this coming recession, guys, what about people that are being forced to retire? You think they're going to be out there spending a boatload of money on trips and cruises and everything? maybe temporarily if they get a big windfall from their company and severance, but I doubt most people would be dumb enough to do that, because that's literally their lifeline to live on for the rest of their lives. So just yet another domino that could be falling right now that can reduce spending and throw us into this recession. If you guys enjoyed this video, make sure you subscribe to the channel, and if you don't want to wait for my next one to come out, check out this video on the screen right over here, and I'll see you in the next one.